This is Mr. Liao again, and this is the final section of Macro, Unit 7.5, Net Exports and Capital Flows. So you can see our objectives are to define capital inflow and outflow, look at how changes in the current account and balance of trade affect the foreign exchange market, and then use the graph of loanable funds to analyze the effect of capital flows on the real interest rate. Back in section 7.2, we looked at the balance of payments. So recall that the current account includes three things: the trades of goods and services, net investment income, and net transfers. In other words, remittances, people sending money from one country to another. The financial account includes sale and purchase of financial assets abroad. We also mentioned what foreign direct investment was when a foreign company buys a business in another country entirely. So we saw this with, I believe, Tim Hortons purchased Burger King. So Tim Hortons is a Canadian company. They bought Burger King, an American company, and basically turned Burger King into a Canadian company. Now, capital flow is the movement of financial capital, which is another word for money, between different economies in an open economy. Capital inflows are foreign funds moving into an economy from another country. For example, Honda, which is a Japanese company, builds a new plant in Tennessee. Capital outflows are domestic funds moving out of an economy to another country. For example, Apple builds a new factory in China to build more iPhones. Net capital outflow is the difference between a country's sale of assets to foreigners and its purchase of assets from foreigners. So a financial account surplus represents capital inflow exceeding capital outflow. Financial account deficit is when an inflow is less than outflow. In other words, the outflow, the money leaving an economy, exceeds the money coming in. Now, if you recall the circular flow of economic activity, we have trade. With trade, exports are injections. When America sells stuff abroad, that money comes into an economy, that's an injection. Imports are leakages. That's when Americans buy things abroad, the money leaves the US economy, goes into a foreign economy, that's a leakage in the circular flow. With financial assets, capital inflows are injections. When people buy assets, foreigners buy assets in America, that's more money into the American economy, that's an injection. Capital outflows, like for example, if an American buys an asset in Switzerland, that money is leaving America, going into Switzerland, that's a leakage from the circular flow. Now, the loanable funds market is used to analyze capital flow in an economy. The inflow or outflow of financial capital shifts the supply curve of loanable funds. Now, when money comes in, it increases the supply of loanable funds because it's more savings into this domestic economy. Outflow means there's less savings, less supply. This is because capital flows affect the amount of money available for borrowers. As a result, capital flows will affect the domestic real interest rate because that money goes into or out of the loanable funds market in terms of supply. So let's take a look again at capital inflows. Capital inflows are money entering an economy. So with respect to the loanable funds, the supply of loanable funds increases. So supply shifts to the right, which lowers the domestic real interest rate. So that's, and capital inflow lowers the interest rate in America because the supply of loanable funds increases. More money is available for people to borrow. On the other hand, capital outflows are money leaving the economy. That is less money for Americans to borrow from because that money is no longer available for Americans. So that shifts the supply of loanable funds to the left, increasing the domestic real interest rate. So money leaving the economy decreases the money available for loanable funds, lowering supply, increasing the domestic real interest rate. Capital flows, as we mentioned, affects the supply of loanable funds. The change in the supply of loanable funds changes the domestic real interest rate. Now that obviously has additional effects because that change in the interest rate will again affect capital flows. Investors will move financial capital to countries with higher real interest rates. So we saw that in section 7.3. People are going to invest in a place where there's a higher interest rate because they can get a higher rate of return on their investments. So it's going to re-affect or re-trigger the loanable funds graph and something else might shift. So if you recall that the current account and financial account always add up to zero, they are balanced. So if there's a current account surplus, that means there's a financial account deficit, which means there's net capital outflow. Money is leaving the economy. If there's a current account deficit, that means it's a trade deficit usually. That means there's a net capital inflow. That means money is coming into the economy in terms of financial assets. So financial account surplus. Now let's look at the causes of changes in the capital flow. There could be changes in net exports, changes in domestic policies, and changes in foreign direct investment. So we'll consider each of these one by one. First, changes in net exports. If U.S. exports increase, there's a current account surplus, so there must be a net capital outflow. In other words, that means a financial account deficit. If there's a net capital outflow, that means financial assets are leaving the country. Since financial assets are leaving the country, that decreases the supply of loanable funds. So that's a change in net exports. Obviously, if it works the other way around, that might increase the supply of loanable funds. Thus, the real interest rates decrease if there is money leaving the country, lowering the supply of loanable funds, increasing the real interest rate. The second thing that could cause a change in capital flows, changes in domestic policies. So we have both fiscal policy and monetary policy. Suppose the government wants to use expansionary fiscal policy, the government needs to borrow more money to finance their spending. As a result, that's going to increase the demand for loanable funds because the government needs to borrow money. They go to the loanable funds market, they ask for those loanable funds, thereby raising the real interest rate. The other way to frame this is if the government goes into the loanable funds market, borrows money, that's less money available for private loanable funds, so the supply of loanable funds could decrease. The result is the same, higher real interest rate due to the government crowding out private investors. In both cases, the real interest rate goes up. So the increase in the real interest rate is going to attract foreign investors. So capital inflows will now increase. Because the capital inflows increase, now the supply of loanable funds increases back. So that decreases the interest rate. So you can see how policies will affect the loanable funds market, affects the interest rate, which affects capital flow, and eventually things kind of cancel out in terms of a balancing of the current account and the financial account. So here, with the increased capital inflow, increases the supply of loanable funds, shifting the interest rate back down. Now let's take a look at monetary policy. Suppose the Fed wants to buy government securities on the open market. This action will increase the money supply, which lowers the domestic interest rates. Since lower interest rates are in America, that's going to decrease foreign investment, which is going to lead to capital outflow. People aren't going to invest in other countries' assets because of the higher rate of return, the higher interest rate. That will cause the supply of loanable funds to decrease, which will re-raise the interest rates back to what it probably was before. So you can see how all these things kind of neutralize and basically affect one another such that you end up back at equilibrium. So those are changes in both fiscal and monetary domestic policies. Thirdly, we have changes in foreign direct investment. Foreign direct investment into the U.S. will result in capital inflows, which will increase the supply of loanable funds. So this is simply put, if people from foreign countries buy a company in America, that's going to increase the capital coming into America. That's going to increase the supply of loanable funds, which will cause the real interest rate to go down. Now, all these actions also affect the value of the dollar in the foreign currency. We saw what happens to the capital flow and happens to loanable funds. Keep in mind, when these foreign investments occur, they have to go to the foreign exchange market and exchange their own currency for the foreign country they want to invest in. So if foreign investment in the U.S. changes, that's going to affect the demand for the dollar, and the exchange rate will also change. So now we're going to proceed with activity 7.5. You can use it as notes, or you can try it and come back to the video when you're done. All right, number 1, Japanese firms have recently increased their imports of American-made semiconductors. As a result, the U.S. current account moves towards surplus and U.S. net exports will increase. So they have imported more American-made stuff. For the U.S. side, that's a net export. Exports go up. Current account moves towards surplus. That increases net exports. Number 2, illustrate on the graphs provided how the relative exchange rates of the US dollar and Japanese yen will change as a result of the increase in Japanese purchases of US semiconductors. So we have the foreign exchange market first for the dollar. Remember, the currency that you're looking at goes in the denominator on the y-axis. So in the first graph, it's yen per dollar. In the second graph, it's dollars per yen. So we start out with these equilibrium exchange rates. Because of the Japanese purchase of U.S. semiconductors, Japan's going to need more dollars to purchase those semiconductors. So that's going to increase the demand for the U.S. dollar, strengthening the dollar. To get those U.S. dollars, Japanese investors are going to have to supply more yen. So that increases the supply of the yen, lowering and weakening the yen. Number 3, illustrate on a correctly labeled graph of the loanable funds market in the United States the changes that result from the Japanese importation of U.S. semiconductors. So we start out with this equilibrium interest rate. Because Japan is importing U.S. goods, U.S. has current account surplus. Since there's a current account surplus, that has to be offset by a financial account deficit or net capital outflow, which means money is leaving the U.S. As a result, the supply of loanable funds decreases, raising the domestic real interest rate. So you can see how the effects of the change in exports affects the loanable funds market domestically as well in terms of capital flow. Number 4, assume that inflation in the U.S. begins to rise while prices throughout the EU remain relatively stable. Thus, the U.S. current account moves towards deficit and U.S. net exports decrease. So inflation begins to rise in the U.S. That means foreigners are buying less American goods. That means U.S. net exports decreases, which means the current account moves towards deficit. 5. Illustrate on the graphs provide how the relative exchange rates of the dollar and euro will change as a result of this change in relative exchange rates. So we start out with the graph of the euro on the left. That's dollars per euro. On the graph on the right, it's the US dollar, so that's euros per dollar. Because of higher inflation domestically, Americans will start importing European goods because they are now relatively cheaper. To get those European goods, that's going to increase the demand for the euro. To get those additional euros, the US is going to have to supply more dollars. So the euro gets stronger, the dollar gets weaker. Number 6, illustrate on a graph of the loanable funds market in the U.S. the changes that result when the relative inflation rates change. So there's our starting point. The U.S. is now importing more European goods, which means the U.S. has a current account deficit because of a trade deficit. Because of the balance of payments, that's offset by a financial account surplus, which means there's net capital inflow. Since there's net capital inflow, that means there's a higher supply of loanable funds. Supply of loanable funds shifts to the right, lowering the domestic real interest rate. 7. Due to a recent recession, expansionary fiscal policies in the U.S. have led to historically large federal budget deficits. On a correctly labeled graph of the loanable funds market in the U.S., illustrate the effects of massive government borrowing. So there's our loanable funds graph. Because of massive government borrowing, you can either shift demand to the right because the government demands more funds to borrow to pay for their programs, or it decreases the funds available for the rest of those that go to the loanable funds market, supply shifts to the left. Either way, and let's use the demand shifting to the right, the real interest rate goes up due to the increased government borrowing. Number 8, the increased borrowing caused real interest rates to increase and foreign investors will increase their purchases of bonds in the U.S. Illustrate this change on your loanable funds graph above. So because of the higher interest rates domestically, remember, foreigners are going to invest where the higher interest rates are. That's going to increase the purchase of bonds, which increases money flowing into the U.S., which increases the supply of loanable funds, thereby lowering the real interest rate. May not be exactly to what it was before, but it is going to go down. So you can see how the interest rate is kind of regulated by trade, by capital flow. 9, assume that the U.S. Central Bank enacts an expansionary policy of purchasing government securities on the open market. This monetary policy will decrease real interest rates in the U.S. So loanable funds market again, because of the change of real interest rates, investors will decrease their purchases of bonds in the U.S. So because it decreases American assets by foreigners, that's going to lower capital flow, capital outflow, or less capital inflow, which lowers the supply of loanable funds, thereby increasing the real interest rate. Number 10, foreign direct investment into the U.S. rose sharply during the second half of the 90s due to the perceived strength and stability of the U.S. economy relative to unstable economies worldwide. On our correctly labeled graph of the loanable funds market in the U.S., illustrate the effect of this influx of foreign direct investment. So there's a loanable funds graph. Since money comes into the U.S., capital inflow, that's going to increase the supply of loanable funds, thereby lowering the interest rate due to the influx of foreign direct investment. Great Britain was a leading investor in American firms at this time. Use correctly labeled graphs of the markets for dollars and pounds to illustrate the relative change in value of these two currencies on the foreign exchange market as a result of British investment in American companies. So there's our graph for the dollar, that's pounds per dollar, and then we have the British pound, which is graphed in dollars per pound. So that means to invest more money in America, the British will demand more dollars. So that's going to increase the demand for US dollars, strengthening the dollar. To get those dollars, they need to supply more pounds. That's going to lower and weaken the pound. So as a result, the dollar appreciates and the pound sterling depreciates. Number 12, the changes above will cause the U.S. net exports to decrease. Why? Because now that the dollar is stronger, and now means that American goods are now relatively more expensive to foreigners. So that's going to lessen their desire to buy American goods. As a result, U.S. exports will decrease. Finally, number 13, the U.S. economy slowed in the early 2000s while American firms discovered less costly production possibilities in foreign countries. On a correctly labeled graph of the loanable funds market in the U.S., illustrate the effects of this capital flight. So money is leaving the United States. If money is leaving the United States, we have net capital outflow, which reduces the supply of loanable funds domestically, thereby increasing the real interest rate. If you have any questions on Section 7.5, you are welcome to ask me through email or a post in Google Classroom or some other way to get a hold of me.